Greetings, everyone. Well, it certainly has been a pretty wild time in the market, and we are here for you in terms of communicating what we know or what we understand at the moment, and that's what I'm here to do. You know, I've been getting the question, what keeps you awake at night? I can tell you honestly, the one thing that keeps me up at night is that as the market goes down and our strategy is punished disproportionately, what keeps me up at night is knowing that some people are going to panic if they're looking at their accounts on a day-to-day basis. You know, we keep saying, almost every time I talk, I say we have a 5-year investment time horizon. At the moment, we are close to, from an expectations point of view, a record in terms of what we expect from our portfolios during the next 5 years at a compound annual rate of return. I've seen it only higher once, and that was after the rout in the fourth quarter of 18. And based on our expectations at that time, we believed that our portfolios would deliver a compound annual rate of return of 42%. So that's 42% over 5 years. That's more than a quintupling. We're just about there again. So again, ahead of just spectacular growth rates, exponential growth rates associated with the innovation platforms, so DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. And even more importantly, the convergence between and among those platforms. We believe that our companies, from a revenue growth point of view and ultimately a profit growth point of view, are going to show exponential growth rates. And we would assume, now we may not be right, but we would assume that the stocks would award them or the market would reward them accordingly. So with that said, just let me talk a little bit about FUD, fear, uncertainty, and doubt, in a market when Chairman Powell, Federal Reserve Chairman Powell, sort of changed his mind from inflation is transitory to perhaps it's not transitory. I think that has unnerved the markets, and we've got investors and analysts fleeing back to their benchmarks. Our strategies typically include stocks that are not in the broad-based benchmarks, and so our stocks are the ones they sell in order to move back into the benchmarks. I've been through this time and time and time again. This is no different. And so we usually do the opposite. We know they're throwing our stocks out, and therefore, instead of trying to get close to any benchmark, and as you know, we don't have a benchmark. We're looking to the future, not the past. We concentrate our portfolios towards our highest conviction names, toward those stocks that have been punished disproportionately, and we believe unfairly in the marketplace. And just to give you a glimpse of what I mean, our portfolios, our strategies have been associated with stay-at-home stocks because they treated us so well during the coronavirus crisis. But the point we've been trying to make is that the world has changed permanently because of the move towards increased digitalization. We're not going back. And therefore, we think that you should start thinking about these stocks, not as stay-at-home stocks, but stay-connected stocks, stay competitive stocks, stay globally competitive stocks, because that's what we do. We're focused on the way the world's going to work, really transformational growth. Well, the labor force, believe it or not, is shrinking. That is a very curious thing when we have more than 10 million jobs going unfilled right now. What is going on? And this was part of our discussion this morning at our brainstorm. The topic of DeFi and DAOs, distributed autonomous organizations, and NFTs came up. It seems as though there are a lot of people who have become a part of this movement. Many young people who graduated from terrific colleges are leaving their engineering and other jobs at Google and Facebook and Amazon to pursue this dream. And they don't even know really where they're going. They're experimenting, they're exploring, and they're trying to find their way in this new world. It's really could define the future of work, where it will be itemized. You have the scale of the internet to support new distributed autonomous organizations. We think while it's somewhat difficult to understand right now, it will become clearer. I always say follow the developers, and that's what we're doing. And they are scrambling into this new world much more rapidly than they scrambled into the internet, I believe, in its early days, or I know, again, because we do watch the developers. That could be causing significant distortions in ways that we won't understand perhaps for years. And certainly the economic statistics are not going to keep up with this. They're going to be revised and revised and revised until the government really has a handle on it. And that could take 10 years. We're probably going to continue to be puzzled by employment reports going forward. Interestingly, in this report, while non-farm payrolls, which really is a survey of corporations, establishments, that metric disappeared. Household employment, which takes into account more small businesses, mom and pop, self-employed, that metric was up 1.1 million units. That's a very strong number. I would not consider this employment report weak. And in fact, there was another metric in it that I found very interesting. The average work week up about 0.5%. That's a very strong metric, and it more than offsets the disappointment in non-farm payrolls. So if we look at average hours worked for the fourth quarter, just kind of get a sense of what that's going to be, it could be more than 5% at an annual rate. Now, if you slap a little productivity on top of that, you could have a 7% real GDP growth quarter, which would be phenomenal. But somehow the market isn't very excited by this. Now, why might that be? Before I get there, I'll just mention one other metric in the employment report, average hourly earnings. They disappointed on the low side of expectations. They were up 0.26%. Expectations were 0.4%. And on a year-over-year basis, they're back down to 4.8, having touched 5% in the original report. So that's interesting, because those who are fearing inflation remember or have read about the wage price spiral that plagued the US economy and many other parts of the world in the 70s. Well, that's not happening, at least not yet. So that's a very important number. And oh, by the way, 4.8% on a year-over-year basis. If we are right and productivity is going to move up 2 to 3 to 4% in the next few years, we should have wage growth in that range as workers become more productive.